This is a lecture on financial statement analysis. This is the first lecture of two that deal with financial analysis that uses financial ratios. So, what is financial analysis? Well, financial analysis is the selection, evaluation, and interpretation of financial data and other pertinent data. Now, what is this other pertinent data? Well, it could be related to the industry in which the company operates and the degree of competition that it's in. It could relate to government regulations or changes in regulations that may affect the company. It could relate to geopolitical situation, how that might affect the company's operations. And there's a great deal of other data and information that is relevant for financial analysis. Now, financial analysts must determine which information is needed and how to use it. There's a wealth of information, and the key is understanding which information is going to be useful in the analysis, and then how do you put it to use. Financial ratio analysis is just one tool of financial analysis, and in this tool we examine the relationships among different financial statement items, different accounts of the company, to form a picture of the company's financial condition or its performance over a period of time. We generally classify ratios according to the different aspects that ratios tend to provide information about. For example, liquidity ratios tell us about a firm's ability to meet its short-term obligations, such as paying its suppliers. Profit margins tell us of how well a firm manages its expenses. And you want to keep the expenses low, but at the same time you want to operate rather efficiently. Turnover ratios tell us how well a firm manages its resources. Now, the resources we're talking about are, for example, its plant and equipment, the physical assets that it has, but also how they're using their capital resources, the funds that they get from bondholders and shareholders, for example. Then we have return ratios, and this is a summary of the amount of profit relative to the resources employed to produce that profit. So we might want to compare profit with, for example, total asset investment. And then financial leverage ratios tell us the degree a firm's fixed financing obligations are used and relative to either the total obligations or total capital, or relative to, for example, the funds we invest from shareholders. And we want to also look at a firm's ability to satisfy or meet these financing obligations, such as paying interest on its debt and paying the maturity value when the bond becomes due, for example. Now, before we look at liquidity ratios, what we want to do is look at a firm's operating cycle. Understanding the operating cycle, which is how long cash is tied up in the firm, is essential for understanding the need for liquidity. Now, the operating cycle involves cash flows, and specifically the operating cycle is how long it takes to turn an investment cash in inventory back into cash. So for a manufacturing firm, we're going to buy raw materials, we're going to have labor, we're going to have all these different expenses. So we're going to put that cash, the company, to work. And then the question is, okay, then we sell whatever inventory we've produced. How long does it take to get the cash from that? The longer the operating cycle, the greater the need for liquid assets. So if the operating cycle, say for a jet manufacturer, that's going to be a very, very long cycle. So they're going to tie up cash for a very long time in raw materials, work in process, finished goods inventory. That's going to be different than, say, a Walmart, where they buy these goods and sell them within a month or two, or a grocery store, where we hope they're going to sell their inventory very quickly. So they would have less need for cash than, say, a jet manufacturer. Now, the operating cycle is the sum of the number of days of inventory. So that's the number of days worth of revenues that we've tied up in inventory specifically, and the number of days receivable. So if the company grants credit, now not all companies grant credit to their customers. So you walk into a discount store, they're not going to grant you credit. Using a credit card is not granting you credit. That's a deal between you and the credit card company. As far as the discount store is concerned, that's cash. So we're talking about when companies provide payment terms for their customers, such as pay in 30 days. And that's typical. It's going to be, there's going to be traditions within an industry as to how long that period is. And so if you're, for example, providing steel to a company that's manufacturing metal widgets, they're going to grant credit because they don't need the cash right away. They're going to grant credit, and so they're tying up cash during that interval before their customer pays. So the operating cycle is the sum of those two number of days inventory and days receivable. So this is a diagram of the cash flow and how it relates to the operating cycle. So you start out with cash, you buy raw materials and convert it into inventory. So there's, say, a manufacturing process or an assembly process. And then you sell the inventory. Now when you sell the inventory, you might get cash right away. It really depends on the type of inventory we're dealing with, the industry we're in, what the customs are, and so forth. Or you might grant them, the customer, credit, and they'll pay you in 30 days or 45 days or whatever the terms are. In that case, you would follow the path to collect on accounts receivable after a number of days and produce cash flow. And then the company puts that cash flow back to use, and so on. So you have a cycle going on here, hence the operating cycle. So how do we calculate the number of days inventory? Well, the number of days inventory, also called days sales of inventory, you'll find several variations on the name if you start Googling this. And it's ratio of inventory to average days cost of goods sold. So what you would do is take the cost of goods sold and divide it by the number of days in the year. So this is the number of days the company operates until they deplete the inventory. So if the number is 30, it means that they can operate for 30 days without running out of inventory. Now, one of the issues that pops up, because we're using financial statement information, publicly available financial statements, well, when we do this, we have to consider what inventory number are we going to use. Now, companies tend to choose their fiscal year end based upon the lowest part of their operating cycle. That way there's less inventory to count at the end. So this has been traditional. Now there are some industries where they're forced to use a fiscal year end of December 31st, such as banking, insurance companies. But other companies can choose whatever fiscal year end they want, and that'll be the low point of their inventory. So, for example, large discount retailers tend to have the end of January as their fiscal year end. So the inventory number you see is at the end of January, and that'll be for the previous fiscal year end. So if we have January 31st, 2026 as a fiscal year end, that's actually the fiscal year 2025. It's always the year where the majority of the days falls. So what we're seeing, if we pull these numbers off of an annual report of a company, we're going to see their lowest level of inventory. If we're really going to dig deep in financial ratios, what we probably want to do is look at the quarterly statements, take the inventory and get the average for the year, because otherwise we're going to have a very low number of inventory and understate the days sales in inventory. But you're going to see a lot of people ignore that issue. So this brings us to the number of days receivable, or days sales outstanding. Now you're going to find sales and revenues are going to be used interchangeably in all ratio analysis. We tend to use sales for retailers and revenues for everybody else, but really the terms are interchangeable. So you're going to see that throughout the ratio analysis, whether here or you start looking in the internet for information about ratios. You're going to see sales and revenues used interchangeably. So days sales outstanding, we're talking about number of days to collect on the credit account. So we take the ratio of accounts receivable to average day credit sales. Now when you look at a financial statement, you're not going to find credit sales. It'll be sales or revenues listed in the income statement. They're not going to tell you what's on credit. This is where you have to know more about the firm than just the financial statements. You have to understand, do they actually extend credit? And many retailers, for example, don't extend credit. But many manufacturing firms do extend credit to their customers. So it really depends on the industry and the customs of the industry. Very often what we do is we simply use all sales or all revenues. While I don't advocate for that, that is traditionally what people do. But if you're really going to be a sophisticated financial analyst, what you have to do is think about the industry and do they actually grant credit? Because this may be an irrelevant ratio to calculate for some firms like Walmart or Target. It's irrelevant. It's not a dimension of the firm we need to look at. Now when you do look at this ratio, the day sales outstanding, you want to compare that to the firm's credit policy. So for example, if they're extending credit to their customers on say 30 days, you have 30 days to pay or 40 days to pay, what you want to do is compare this ratio, the day sales outstanding, with their credit. Are the customers tending to pay much later than what they're permitted? Should you have a lot of accounts that are not paid when they're supposed to be? Or are they paying faster? And maybe your credit terms are just more liberal than they need to be. So you use that to evaluate the credit policy of a company. We also have that issue of whether we use year-end or not. So if it's the low point of their operating cycle, then it could very well be the low point of their accounts receivable, so the numerator would not be very representative. So that's a sticky issue that we have to look at, and if we're going to do a more sophisticated analysis, again, we probably want to look at quarterly numbers. For a company that is granted credit from its suppliers, we also look at the net operating cycle. Now what we do is we look at the trade credit that is granted to the company. Trade credit is the liability that results from a company's vendors, the suppliers, not demanding immediate payment in cash, but they give terms that require payment within a specified period. And that could be 10 days, 30 days, 40 days. But it becomes a liability, which we refer to as accounts payable. The net operating cycle, distinguished from the operating cycle, incorporates the fact that the company may extend this trade credit for its purchases. So cash does not flow out of the firm immediately. So when it buys its raw materials, if it's been given trade credit from its suppliers, then they don't have to pay right away. They may have a time period where they can actually pay, 10 days later, 20 days later, whatever the terms are. And again, it's going to be customary for that particular industry. So what we do is we calculate the net operating cycle, considering that we don't have to pay out cash for those raw materials right away. So calculating the net operating cycle, we first have to calculate the days payables outstanding, DPO, or number of days payable. And this is the ratio of accounts payable, so from the liability section of the balance sheet, divided by average days purchases. Now, you're not going to find purchases on a financial statement, but you can back into the number. If you remember the accounting relationship, that if you take the beginning inventory plus purchases, that should be equal to cost of goods sold plus ending inventory. So that's basic from accounting relationships. Therefore, we can back into purchases as being the sum of the cost of goods sold plus ending inventory minus beginning inventory. So DPO, the days payable outstanding, is how long it takes the companies, on average, the company to pay on its accounts, what it owes its vendors or suppliers. So what we can do is put this all together and come up with the net operating cycle, or also called the cash conversion cycle. So it's the number of days it takes to turn in investment and inventory into cash, considering that purchases are acquired with credit. So what we do is we take the number of days sales of inventory, days sales outstanding, so that's our operating cycle, those two numbers added together, and we subtract the days payables outstanding. And that gives us our cash conversion cycle. So now that we've determined our net operating cycle, we can take a look at liquidity ratios. Now, the most common liquidity ratios that people cite are the current ratio and the quick ratio. And the current ratio, also called the working capital ratio, is the ratio of current assets to current liabilities. And we're basically getting an idea of a firm's ability to satisfy the current liabilities using its current assets. So this is kind of a broad, sweeping statement that we're making here, but we think about current assets being assets that can be liquidated into cash within 1 year, and current liabilities are liabilities that are due within a year. Now we can get a finer take on this with the quick ratio, also called the asset test ratio, and it's the ratio of the quick assets. So those are ones that we can think of could be converted to cash very quickly, say within 90 days, and compare that number to the current liabilities. So why do we leave out, we basically are going to sum cash and accounts receivable, but we're going to leave out inventory. So what we have here is a ratio that says what we could really do if we really had to do this quickly. Now, the reason we can talk about receivables as being a quick asset is you can easily sell your receivables. You sell them at a discount from what you normally get from them, but you can sell them quickly. It's a lot harder to liquidate inventory. That cannot necessarily be done very quickly, say within 90 days. And so we have the use of quick assets, which are usually current assets less inventory. So we take the ratio of the quick assets to current liabilities, and we end up with the quick ratio. Now, with each category of ratios, there are many more than what I'm showing you in this lecture. But just as an example, we can create other liquidity ratios using financial statement information, such as the cash ratio, or the net working capital to sales ratio, or current assets to total assets, or operating cash flow to sales. And there are many more. And basically, as an analyst, what you would do is you'd be very familiar with how the industry operates and how the firm operates, and you may choose one ratio or another depending on what's most appropriate for your purpose. I mean, they all measure liquidity, but they use different information. For example, we think about net working capital to sales. If we're comparing companies in the same industry that operate very, say all discount retailers, we think they should have the same relationship between the net working capital and their sales. They should all be in the same ballpark, if you will. And so we would expect that ratio to be very similar among peers. But it really depends on, your specific preference, but also the specific company or industry in which you're evaluating. Well, now let's take a look at profitability ratios. Here, remember what we're doing is we're looking at how a company manages its expenses. We want them to manage them well. Well, how do we measure how well they're managing? Those are the profitability ratios. Profitability ratios include what we refer to as profit margins. So in this case, we're looking at different elements in the income statement compared to sales or revenues. So the most common profit margins are going to be the gross profit, operating profit, and net profit margins. So you'll notice in comparing these three ratios that we're looking at different stages within that income statement. Gross profit, remember, from accounting is going to be revenues minus cost of goods sold. And that should be fairly similar across companies in the same industry. Then we have operating profit. So what we're doing is we're also taking gross profit and subtracting selling general and administrative expenses and arriving at operating profit, also known as EBIT, and compare that with revenues. And then last of all, we have net profit margin. We compare net profit to revenues, the bottom line, if you would. Now, across different firms in the same industry, the gross profit margin, operating profit margin would be similar, but the net profit margin may not necessarily be similar. So, when we interpret a profit margin, we have gross profit margin. These should be similar for companies in the same line of business. Now, some firms, say manufacturing firms, some may be more efficient than others. But there's so much efficiency you can get to really differentiate yourself from another firm. So those gross profit margins are going to be similar across firms. Operating profit margins will be similar, but if some firms have a better control on their administrative costs and payment of executives, for example, selling costs, their marketing costs, or other such expenses like utilities, they will have better margins. And then net profit margins will differ primarily because different capital structures. Some may use more debt than others. Well, debt, you have an interest expense. That interest expense will make a difference between operating profit and net profit. And so that makes a big difference, and therefore comparing companies across, and we look at net profit margins, we're going to see some differences solely based on differences in how they choose to finance the firm. Now, there is a relationship between profit margins and returns on assets, returns on invested capital, and returns on equity. Now we'll take a look at activity ratios. Remember, with activity ratios, we're talking about how we put our resources to work. So those resources may be the capital resources, such as the funds we get from bondholders and shareholders, for example, or maybe net plant and equipment, the actual physical assets that we've invested in. Probably the most common activity ratio is the total asset turnover. And here we're comparing revenues and total assets. Revenues is what you get out of putting your total assets to work. So the denominator, total assets, is what the resource you're putting to work, if you will, and what you're getting out of it are the sales or revenues, if you will, and so that's in the numerator. So that's the total asset turnover. It's going to be cited in terms of number of times. Now that number can be in decimal form, like 0.4, or it may be a whole number, like 3 times, or 5.5 times. So you're going to find it in terms of number of times. And then the fixed asset turnover, you're comparing the revenues with the property, plant, equipment. You're usually pulling off the net property, plant, and equipment number from a financial statement, from a balance sheet. And then you compare it to the numerator, revenues or sales, depending which term you want to use. And again, it's number of times. We can also use activity ratios to assess accounts receivable and inventory. With regard to accounts receivable, the accounts receivable turnover is the number of times receivables are created, that is, you're selling the item for credit, and collected in a period. So it's the reflection of the effectiveness of the company's credit management. For example, if you give your customers terms saying you must pay within 30 days, and you find that the accounts receivable turnover is such that they're not paying within 30 days, that is, the receivables turnover is less than, say, 12, then you need to look at the collection policy and the credit policy of the company. It's calculated by comparing the annual revenues or sales on credit to average accounts receivable. Again, we can use the end of year accounts receivable, or we could take the average of the end of each quarter. If a company is seasonal, we probably want to do the latter. In most textbooks, they'll simply take the end of period accounts receivable, that you find on the balance sheet. Inventory turnover is the number of times inventory is created and sold during a period, and you're talking about a measure that's used to assess the production or retail operations, depending on the type of firm. In this case, we compare cost of goods sold divided by the average inventory. Again, you could use end of period inventory, but you'd have more information if you used the average of the 4 quarters in a seasonal company. Now, with both accounts receivable and inventory, we had looked at the number of days of sales and credit and number of days sales in inventory. We had looked at these number of days earlier in context of the operating cycle. What you should see if you lined up these formulas is that the accounts receivable turnover multiplied by the number of days sales in accounts receivable should be equal to 365. Likewise, if we take the inventory turnover and we multiply it by the number of days of inventory that we have on hand, we should get 365 as well. Now let's take a look at financial leverage ratios. When we're talking about financial leverage, we're talking about how a company finances its business. Do they do it with all equity, or do they do it with some combination of debt and equity? And you always have to have some equity. There's always an ownership interest. And the question is, does the company take on debt? And if so, how much? And then can they handle it? Now, common financial leverage ratios include the debt to assets ratio and the debt to equity ratio. The debt to assets ratio is the proportion of assets financed by debt. And we're talking about both short-term and long-term debt. And we're comparing that to total assets. And then the debt to equity ratio, we're talking about how much debt there is relative to shareholders' equity or stockholders' equity, whichever name you want to use. And the debt we're talking about here is interest-bearing debt. So we're not talking about accounts payable, accrued wages, or any of that, but we're talking about interest-bearing debt that can be short-term, such as the current portion of long-term debt that's due, or some notes payables that may be due within a year, may be classified as short-term, but they are still debt. Now, debt is defined as interest-bearing liabilities. So liabilities are what the company owes. Now, all debt is a liability, but not all liabilities are debt. In the examples that I just gave, accounts payable, accrued wages, they're liabilities, but they're not debt. And then we have debt that would be bonds, if the company issues bonds, notes, they may borrow in a intermediate term basis, that'd be a note. We have short-term borrowing, say from a bank, and also capital leases. That gets to a very complicated subject, but capital leases are considered debt. Now, in terms of financial leverage ratios, a common ratio is also the interest coverage ratio, also called times interest earned ratio. And you're talking about the company's ability to satisfy its interest expense obligation. So in this case, what we would do is compare the income that's available to pay interest, which would be earnings before interest and taxes, or EBIT, and compare that to the interest expense. So this is a type of coverage ratio, how many times. So the result that you get here is number of times, whether it be 1 time or 2 times or 3 times. And the reason we look at this one, it's often a condition in a bond agreement, a bond indenture. And it would specify, for example, the minimum interest coverage. For example, it may specify that interest coverage ratio must be at least 2 times. Now you can take this ratio and look at other fixed charges beyond interest. So you could look at rental, you could look at pension obligations, you could look at lease obligations, or many other types of fixed obligations that a company may have. And you could also do a coverage ratio with those. When you do that, however, keep in mind that what you want to do is, in the numerator, have what is available to pay, what is on the denominator. So if you're, for example, going to include rental expense in the denominator, then you need earnings before interest, taxes, and rental expenses. So you have to make sure that the numerator and denominator are consistent. Now we'll take a look at the DuPont system, and the DuPont system is a way of looking at ratios. We're going to take a couple ratios and break them down into components, which can give us a better idea of what is going on within a company. Now what we want to do is first look at return on investment ratios. Now one is the basic earning power ratio, and you're talking about comparing operating income to total assets. So we think about putting the total assets to use, and the result is earnings before interest and taxes, or EBIT. And that is also a type of return ratio. Then we have return on assets, which is comparing net profit or net income, whichever term you want to use, with total assets. So you're putting total assets to use, and what you're getting out of it is a net profit. Other return ratios are the return on equity and return on invested capital. Return on equity compares net income or net profit to shareholders' equity. So we would take the net profit or net income from the income statement. We would take the shareholders' equity, also called the stockholders' equity, from the balance sheet. And we basically get an idea of how much profit is generated per dollar of shareholders' equity. Return on invested capital is similar, but what we're going to do is take the net profit and subtract dividends and then divide by invested capital. Now you'll find some formulas that don't subtract the dividends in the numerator, so you'll have a comparison of net profit to invested capital. There are many different variations. There are definite variations in the numerator, but also in the denominator. Invested capital is generally viewed as the sum of debt plus equity. However, you will have some analysts that take the debt plus equity sum and subtract off non-operating assets, the cash and marketable securities. So there are variations on return on invested capital. The DuPont system was developed by the DuPont Corporation, and they used it as an internal mechanism to evaluate management and production of the company. And it involves decomposing return ratios into their various components. Now this can get to be a very complicated system, but let's look at the simplest method, which is to look at return on assets and break it into two components: the total asset turnover and the net profit margin. Now if you take those ratios and you put the formulas in, say revenues over total assets and then net profit over revenues, you'll see that you can cancel out, in this case, revenues, and you're left with net profit on the numerator and total assets on the denominator, which is return on assets. So in other words, we're taking return on assets and breaking it into a measure of how effectively we're using the assets, and then another measure of how effectively we're managing expenses. We can break the return on equity into three components. We start with a return on assets, and we multiply it by the ratio of total assets to equity. When we say equity, we're talking about the shareholder equity or stockholders' equity from the balance sheet. And what we're doing here is taking return on assets, multiplying it by what's called the equity multiplier, the ratio of total assets to equity. Now we can then substitute what we did in the previous slide and break return on assets into two components. Now if we were to write out the formulas, you would see that we end up canceling out again. We cancel out revenues and we'll end up canceling out total assets. And so what we're left with is the ratio of net profit to equity, and that is the return on equity. So in other words, we can break return on equity down to a measure of utilization of the assets, management of expenses, and how the company chooses to finance itself. Another way to look at this is to take the return on equity, break it out into its components, return on assets and equity multiplier. Return on assets we can break down to two components, net profit margin and total asset turnover. And we can actually, if we really are ambitious, break down net profit margin into operating margin, so focusing just on operations, interest burden, and tax burden. Now we're not getting into that detail, but I put it here to show you that you can take this farther, and this gives you a finer look at what's going on with the performance of the company. So why do we use the DuPont system? Well, we use it to look at what's driving profits and revenues. And we can use it to diagnose issues and trends. So if we were to look at the components over time, that'll tell us something about how these returns change over time. Now let's just take a look at Target Corporation. And if we look at Target's returns in the left graph, we see that in 2014 and then in 2021, there were some unusual returns. Return on equity dropped quite a bit in 2014, and then in 2021, we saw an uptick in return on equity. And you can see the effect of financial leverage going on here, because what financial leverage does is when profitability is good, it exaggerates it on the positive side. And when profitability is less, it exaggerates it on the negative side. And that's what you can see happening in both 2014 and 2021. If we go to the right-hand side graph, we see the components, and we can see that total asset turnover has risen slightly over time, and we would look at the right scale for number of times for total asset turnover. And we also see the equity multiplier, that is the use of financial leverage, increased. It didn't change in 2014, but it did increase after 2021. So what was going on in 2014 and 2021? And it's the net profit margin that was driving everything. The net profit margin dipped considerably into the negative side in 2014, and then there was an upward movement in 2021. So net profit margin was driving the returns. So in other words, how Target was managing their expenses was really driving their returns, as opposed to how often the assets, the inventory and other assets turned over, or how they financed the firm. What was going on was the management of expenses. Now we could then break that down into finer detail to look more precisely. And so this is just how you can start looking at a company and how these play a role. Now we'll take a look at shareholder ratios, and shareholder ratios are from perspective of the owners. And these are ones that you see quite a bit quoted in financial news about a company. You often hear about earnings per share, EPS. That's talking about how much income is earned during the period per share of common stock. Now this would be a number like $2.50 or $1.50. Could also be negative if there's a loss. Now there's something called basic and diluted. We're not going to go into the detail of that, but they're basically the difference between basic and diluted is in terms of the number of shares of stock that are considered. Whether or not there are, for example, executive stock options out there that could be exercised, and the executives would therefore get granted more shares of stock, and that would change the number of shares outstanding. That's just an example. There are many other factors that can influence the difference between basic and diluted. Book value equity per share, you're talking about the book value of common equity. So you're taking the shareholders' equity or stockholders' equity right from the balance sheet, and you're dividing it by the number of shares of stock. And then the price earnings ratio, also referred to as the PE ratio, it's the ratio of the price per share of stock compared to the earnings per share. Now there are different variations on PE ratios. Sometimes we look at leading, so we're going to use expected earnings per share, or we have a PE calculated looking back at the last 4 quarters of earnings. So you'll see some variations in the PE ratio calculations. Now dividends per share, DPS, is, as the name implies, what the cash dividends paid were during the period compared to the number of shares outstanding. So we're talking about cash dividends paid per share of stock. And then now not all companies pay dividends, so this may not be a relevant ratio for some companies. Dividend payout ratio is the ratio of the cash dividends paid to earnings. So earnings would be net income or net profit, and then the dividends would be the cash dividends for the year. And this says, what proportion has been paid out. You can also look at the complement of that is how much is retained in the company. That would be the retention ratio. So this is the dividend payout ratio. So it's a proportion of earnings that are paid out to shareholders. Now there are many other ratios that you may see, say market to book ratio. So here we're comparing the market value of stock to the book value. Book value is according to the balance sheet. Market value, the stock, would be the price per share times number of shares outstanding. And so you're comparing the market value to the book value. Some people interpret higher number of this as being indicative of a higher growth firm, but it's just kind of a ballpark guess at that. The PEG ratio is the ratio of the price earnings ratio to the growth rate. And sometimes the PE ratio is interpreted as expected growth. Now these are all imperfect measures of expected growth, whether it be the market to book ratio or the PEG ratio. But this is what some people use to proxy for what the market believes to be the growth rate of the company in the future. Price to sales ratio, as the name implies, we're talking about the market value of equity to revenues, or you could look at it in terms of price per share of stock relative to revenues per share. So you can look at it either way. And then you have enterprise value to revenues. And enterprise value is generally the sum of the market value of debt and the market value of equity, less any cash or cash equivalents. And you compare that to revenues. And that's the enterprise value to revenues. Now just a few notes, because we've gone over quite a number of financial ratios. But keep in mind that there are hundreds of financial ratios out there, and we've just presented a sampling of these. And within a given industry, we might develop very industry-specific ratios as well. So keep in mind you haven't seen everything. You've seen just a sample. Now one thing to keep in mind is that a given ratio itself does not provide much information. For example, if I tell you that the current ratio of a company is 2.0, we can't interpret if that's really good or bad. Yes, it says that you could probably cover your current liabilities, but we can always think of a lot of exceptions where that really wouldn't be the case. Maybe the current liabilities are due a lot sooner than how fast we can liquidate our assets. So you have to think that it's not the number itself. What you want to do is compare the ratio with that of the company's peers, but also look at trends within a company. What has the trend been in that ratio? For example, is liquidity getting higher? Well, it could be too high. So you've got to be careful interpreting a particular number or even a particular trend. If a current ratio is 5.0 and all the peers have a current ratio of 1.5, well, maybe the company has put too much into low and non-earning assets. So you have to think, is that good or bad? Well, you have to put in perspective of other ratios too. So you have to look, well, what kind of returns are they getting on the employment of the assets, and so on. And so it's always important to look at different types of ratios to get a full picture of the company, because what you want to do is, okay, we look at the liquidity ratio. I can't tell whether that's good or bad, and I can't even tell if the trend's good or bad. But if I look at the trend in the returns, that will provide information of whether the company is putting its asset to good use or not, and that can tell me something about whether that liquidity is sufficient, or maybe we have too much in liquid assets. Now, when you do a financial analysis of a company, you have to have a very good understanding of the accounting that underlies the numbers that you see in the financial statements. You can't just use the numbers without understanding where they came from. What method of inventory did they choose, for example? What method of depreciation did they choose? There are many choices that companies have within the accounting rules and still be consistent with generally accepted accounting principles, but a choice of accounting methods can provide a slightly different picture. So you have to understand the accounting methods a company has. You have to understand the choice of fiscal year end. You have to understand the nature of the business and how much is necessary to have, for example, in operating assets. And so there are a lot of things that you have to understand about the company, and understanding the accounting is very, very important. So this is the end of the first lecture on financial analysis.